Yeah, good evening, everyone. Welcome to this webinar. Thanks for joining in. As the agenda states, today we'll be talking about the one of the most significant reforms over the last 10, 15 years, particularly on the demand side, GST 2.0. So for this, we have with us Mr. Arshad Borwake. He is the head of research, equity, and fund manager at Mirae Asset Investment Managers Limited. Welcome, Arshad.
Yeah, hi. Thank you, Shrenik. Good evening, everyone.
Yeah, so this has been one of the most significant reforms in the recent past that we have seen. And what we are trying to do here on this webinar is we'll try to understand what actually this reform has been and how it will impact the overall economy and the markets. We'll try to understand over the course of this webinar. So to start with, Harshad, uh, can you just brief the audience in terms of what overall how has been the reform in terms of which all segments broadly this reform has touched upon and why it has been touted as one of the most significant reforms in the last 10, 15 years?
Sure. So, yeah, I think if you recall when the GST was implemented in India a few years back, so almost 8 years back now. So, at that point in time, when India shifted to the GST regime, so at that point in time, what government had done was not really try to tinker with effective tax rates for each segment. So they kind of shifted from whatever earlier taxation was, in each product. So they had moved to, so they didn't tinker in terms of, somebody, which was in and around 28, they kept it at 28, somebody around 12, 18. So they tried to do that because challenge at that point in time was more about a smooth implementation of GST. And, the focus was not more on rationalization or reducing the number of brackets. But now we know 8 year hence, I think it's a decent time period with government and everyone, including the supply chain, consumers. So now largely everyone is in sync and settled in terms of GST implementation. And this was also the time, as you recall, which we'll see in the subsequent slides, is that this is also the time where consumption in India per se had weakened. So there was something, which was needed to be done. And mind you, this reform, as the finance minister said, it has been in the works for the last 6 months, which obviously was initiated by our prime minister. So there was a discussion, detailed discussion with all the states, because one of the issue when the rates are reduced, which means the GST revenue goes down. So both gets impacted, state as well as the central government. So here what they have done, coming to GST 2.0, what is implemented, so they have simplified the rate structure. Now we just have 5% and 18%. So they have done away with 12% and 28%. And some sin goods, what they call it, as has moved to a 40% category. So broadly, if you look at, while it's quite detailed, and I think for the last 2 days, everyone would have seen in the newspapers, big pager advertisements. Will not go much into details what has happened, but I think essentially what they have done is few items, particularly on the educational side and the insurance side, that has moved to the nil rated GST category. And then some items like some obvious things, like for example cement, right? So in the first place, if you go logically, there was not much of a case to have it into a 28% tax bracket. Secondly, if you think from the entry level cars, two wheelers, which essentially is for a lower middle class or middle class, of a generating income generating family. So that too again at 28% logically did not make sense. Some items, you see, India clearly has moved in the last 15-20 years. So once upon a time, things like AC and all used to be luxury. Now it has become a, I would say, a necessity kind of thing. So that also, these items has also moved from 28 to 18%. So these are the few large changes, large categories which I can think of has they have done. And then on the categories which has moved to the 5%, I think they are largely, I would say, FMCG kind of products. Some products are also on the healthcare side, some on the agriculture side. Typically these are large mass consumption products. These also happen to be large pie of expenditure for a lower middle class or even poor family. So to that extent, moving to 5% is kind of a apt move, what they have done. I think largely Shrenik, I think this is what I think say as a headline level, I would say. But I'm saying, everybody in the last 2 days would have gone through all this. So let's not spend too much, time on this.
Sure, sure. So broadly, mass consumption items the GST rates have reduced there, which will lead to a lot of consumption demand revival. That is what the intent of the government is.
Clear.
Hopefully, the execution also should be, in a sense, should be effective enough that the entire benefit pass through the end consumer.
Yeah, I think you have touched this important point. Obviously, one is government which has done, rate reduction. The transmission of the same is also important. If you recall at last time when the GST was implemented, government did, actively monitor in terms of, how the transmission happened. The number which I think they gave during the press release was there were 700 or 705 incidences in terms of profiteering. I think the amount which they mentioned was roughly around 4,500 crores. So this time around, as such, there is no body, which could monitor, whether it has passed on or not. But I'm sure I think government will keep tabs, how these companies or different sectors how it is getting passed on.
Sure. Just to remind participants, in case if you have any questions, you can put in the chat box, and through the end of the webinar, possibly we'll try and address most of the questions you have. So, Arshad, going ahead, in terms of, while you alluded to broadly what all segments in terms of product items which wherein the rates have reduced and they stand to benefit, if you can broadly tell our audience in terms of which are the particular sectors or segments which will benefit out of this?
Sure. So what I'll do, I'll cover a few of the important large sectors, large in terms of, because, we are thinking more from the equity investment point of view, large which are part of the indices and also part, large in terms of the portfolios. So one obviously, one should discuss is, what has happened on the auto side, right? On the
Right.
auto front, as I said, for the two wheelers, small cars, buses, they have done some, small cars, for example, less than 1200 cc in petrol, and I think 1500 cc in diesel. So there, I think the number has gone down from 28% to 18%. So as you would recall, see, any which ways the sector was going through, I would say the down phase. So to that extent, I think this was a much needed, reduction in terms of taxation. And now we are in the midst of festive season, so I'm sure, we will see revival. There is a lot of hope that, in terms of revival of the demand on the auto side. Second, if you think from the consumption point of view, consumption, as you know, is a vast, sector, but within that, two primary segments in terms of consumer durables and electronics and FMCG. So on the durable side, basic things like, TVs, ACs, dishwashers, so that has gone down from 28 to 18. Again, as I said, once upon a time, these things used to be a luxury. Now they have become necessity. So to that extent, I think, and also the other factor is the penetration. If you look at, in all these segments, so penetration is quite low. So I think we would have a double benefit in terms of, penetration increasing plus lower pricing. So to that extent, I believe that we would see, good growth coming back. Consumer staples, obviously, it doesn't mean, if the shampoo price or toothpaste price is gone down, that doesn't mean, we'll consume it more. But I think the way to look at it is, if 18% goes down to 5%, which means you save some money on this product, so additional money which is available to the household, which can be consumed somewhere else. So which I believe could go into the discretionary products, and discretionary within that is pretty large segment, which could include retail, QSR, and other sub-segments, even sectors like footwear and all, where I think on the footwear side, if you remember, once upon a time, before this GST reform, there was a concession of footwear below 1,000 rupees. Now that their number they have moved up to 2,500 rupees. So I think that the money which is saved on the FMCG front can be, households will be able to consume into the other sectors. I think one other important sector I think which I wanted to cover was healthcare, or sorry, insurance per se, right? So both on the healthcare side, so the rate has moved down to 18% to nil. It doesn't mean it has moved out of the GST, but it's a nil rated. I think that's what they are trying to say. So to that extent, the policy prices will go down meaningfully. There is also some issue that the insurance companies will not be able to offset the impact completely. So maybe I think what could happen that instead of prices going down by 18%, prices might go down by 12-13%. But nevertheless, I think it's a big positive from the sector point of view. Insurance is one sector which I think is hugely underpenetrated in India. So, and which government is also trying to increase the penetration. I think clearly it's a big positive from the sector point of view. Some sectors which has moved to the 40% category, they are mainly I think something which is harming your health, or typically called sin goods, what they call it as. So that has moved from 28 to 40. There again, I think what they're trying to do, for example, on the cigarette front, what I think clarification which came yesterday, looks like eventually it will be a neutral kind of number from earlier tax regime. So for now, the cess will remain, but eventually it will be neutral. So 90% of the things I think which has done are positive, both from the earnings, consumption, demand, revival point of view. Few things which are moved into negative, I think nobody will complain, on those sectors which are moved into the higher tax bracket.
Sure. So, Arshad, while you mentioned the benefits, we also need to understand from a fiscal perspective, since they are giving this benefit, so that will also lead to some revenue loss to the government. So, what happens on that side? Will they be able to manage it from a fiscal point of view? Is this a fiscally prudent reform that they have done?
So I think from what we understand, while I think if you look at the government release and also the press conference which has happened, so the numbers were while the numbers are large, but clearly they are not spelled out whether how much for FY26. So what they have said, all the numbers which they are talking is on the based on FY24 basis. So that's point number one. Secondly, when you say whether it will be fiscally escalating or neutral, so I think looks like it's largely fiscal neutral. So what government is trying to do that if when the GST was implemented, so at that point in time, government had promised to the state governments that for every year I think 14% increase in their own GST revenue was promised to the state governments, and that scheme was again extended. Now this GST compensation scheme is coming in end somewhere in FY26. So to that extent, I think there was some saving to the government to the tune of almost $20 billion, which could have happened. So I think government has tried to use that money, in terms of doing this reduction in GST. But again, numbers are quite fluid. If you think what government has tried to say, that net impact for the government is roughly 48,000 crore. That's what government has said. As a percentage of GDP, this comes out to be a very small number. On a fiscal deficit, it will not impact so much. There are some other levers which government can use. For example, they can push pedal on the divestment side. Then there is some room in terms of getting more dividend from the RBI. So fiscally, clearly, it's largely, I would say, non-event, neutral kind of event. But as a percentage of GDP, this number can anywhere be between 0.6 to 1.2%, depending on what assumption you make. I think for our sake of discussion, we can say it can easily add 0.6 to 0.8% to the GDP now, as a percentage of GDP.
Sure, sure. So going ahead, just to understand the context, why this reform has been done, the timing of this reform, if you can just brief our audience in terms of why GST reform now.
Sure. Yeah, I think this is as an equity investor, I think we should more focus on this, other than obviously one needs to see what has happened. So if you if you look at FY when we started FY 24, right? So at that point in time, if you look at Nifty earnings, so the charts which you see in front of you are the quarterly growth numbers for Nifty 50. The top chart is EBITDA growth and the bottom chart is PAT growth. So as you can see, last few quarters, the EBITDA growth for Nifty 50 has been in the single digit. So is the PAT growth. So clearly, there was some weakness in the economy. There was some weakness in the corporate earnings. So when we started FY 24, the consensus estimate was saying that there could be a growth to the extent of 12 to 13%. But we ended, sorry, I was talking FY 25, but we ended FY 25 with I think some 1 to 3% kind of number. And the big decline from expectation of 12% and down to 2 3%, it was largely driven by weakness in the consumption, particularly on the urban side. So we saw a discretionary consumption going down. Things like building materials didn't really do well. So there was a big decline on the consumption, and that is what you are seeing in terms of the corporate earnings. So this was a big factor where government realized something needs to be done in terms of consumption. I think this is the context which I would give in terms of corporate earnings. So this was the driving factor for this reform. Yeah, I think this is a very interesting slide. So what we have done is, in terms of the trend, in terms of the consumption growth, this we have taken from pre-COVID till now. So the dotted blue line, if you look at, is the trend. Typically, our consumption was growing, but then, as you know, the COVID event took place. So to that extent, there was the consumption got dampened. Now, COVID is over. We are back to normal growth, but consumption is the one engine which has not fired yet. We are still meaningfully below the trend in terms of pre-COVID. So if you just try to look at what is the gap between what it should have been and what it is, so as the chart suggests, there is almost a 17% gap in terms of what our consumption should be and what it is now. So I think this is what, again, setting the context, this is what the government is trying to address. And mind you, in case it gets addressed, so this is the jump which we can see over the coming period in terms of consumption coming back. Again, yeah, I think here, one is domestic factors, which, as said, are important, and second is the global context, right? On the global front, I think let's not spend too much time, but clearly there is a issue in terms of geopolitical turmoil which is happening. Then there is a the tariff issue led by US, and everybody is negotiating, but we are still not seeing the end of it. While everything is happening, the reality or the casualty of all this global growth coming down. So this is the reality. I think in this context, while from the India perspective, if you look at while we are quite insulated, I would say, given that large part of the economy is still domestic driven, domestic consumption driven. Even from the export point of view, we are not too much dependent on the export. There are few sectors which will get impacted by this global growth sectors, like, let's say, IT or pharma to some extent. But net, I think we are clearly insulated. Yeah, I think tariff, as you know, this, as I said, it's a new ongoing challenge in terms of India now, because we are buying Russian crude. We are being punished and moved to a 50% tax bracket, as you can see from the left hand side chart. So we are the second largest after Brazil in terms of effective tax rate. Effective tax rate for roughly is at around 30 to 33%. Why 30 to 33? Because there are some sectors which are exempt in terms of tariff sectors like pharma for now is not part of it, and then some segments which are exempted. If you look at right hand side, we have given some segments which are exempted. Electronics is the other important factor. Some part of chemicals, some part of metals is not a part of a tariff. So that's the reason instead of 50%, we are at around 30 to 33%. But the reality is, this is an ongoing challenge. While, as I said, we are relatively better insulated vis-a-vis other countries, but nevertheless, we will see, some marginal impact of this. So that is another context when I was trying to say that, there was weakness on the consumption side, and then there is some impact of this global weakness also. So other important factor, I think, which we need to know, India historically, if you see, one of the issue or our own Achilles heel, I would say, is the crude price. So despite all the turmoil, thankfully, I would say, and because of various reasons, the OPEC has been increasing the supply, US shale supply is higher. So the positive part in all this, all this flux is that oil prices continue to remain low. Obviously, there is there is a disruption on the gold front, where because the global central banks, because of again issues like dollar de-dollarization and all, so global central banks are buying gold significantly. To that extent, gold prices are higher. But for us, I think the big positive is oil price, is lower, and that is a positive point for us. I think that is the context within which I think this GST reforms were uh, took place.
Sure, sure. So, while you talked about the context, what's changing in terms of what has happened so far in terms of the actual growth? When it comes to credit growth, it is quite weak. RBI has taken a lot of measures to revive credit growth through liquidity, through rate cuts. So, if you can just let us know, our audience know, in terms of what is happening now and what can change from here on based on this reform and how to go about it.
Sure. So I think one highlight which I wanted to talk in terms of what's happening on the ground. I think one big highlight is the rural recovery in India. I think according to me is underway. Uh, if you look at on the left hand side, wage growth, right? So that is very good indicator in terms of whether economy is doing well or not. So rural wage growth, both for agri and non agri, in the recent period we are seeing that that is doing well. Second is in terms of output of product, agri product. Bottom left side, it's a wheat output. I think that is also doing well. Bottom right chart, if you look at the NREGA enrollments, the higher the NREGA enrollments, which kind of indicate that the economy is not doing well. Here we can see the NREGA enrollments are going down. So I think the one highlight or on the ground, if you were to ask me, is that I think the rural. I'm not saying it's firing all cylinders, but I'm saying rural economy is getting much better. This year, as you know, monsoon has been again much better than higher than average. So to that extent, I think yes, this is the one thing which I wanted to highlight. And if you look at recent quarter corporate results, so there again, if you look at here all the corporates, so everybody is kind of agreeing or in unison that rural economy is doing quite well. We'll talk on urban in some time, but I think this is what I think on the ground reality is right now.
So, while you talked about rural revival happening, and hopefully we should see this continuing and strengthening more. And as you alluded to, urban has been weak for some time now, and hopefully through this reform we should see a revival even in the urban demand. What has been the support through government in terms of monetary and fiscal policy? How they are supporting growth? Will this lead to a better economic growth going ahead?
Sure. So I think again, I think, clearly both monetary and fiscal for India, we are fortunate, both are quite in sync. You can see what's happening in the US, right, in terms of how they are not in sync and not trying to fight with each other. But to give a context again, from the interest rate, right, one of the most important factor for any economy. So here what we'll try to see, what is happening globally. So right from 2008 to I think somewhere around 2019-20, if you think from the interest rate cycle point of view, the interest rate kept on doing going down, because in 2008, central banks had taken decided that whatever it takes, we have to support the economy. Then the COVID happened, supply chain issues happened, inflation moved up. All the central banks, the mandate is to control the inflation, so again they moved up the interest rate. Now, I think we are in the midst of interest rate reversal cycle. Already, RBI, as you know, in the last two instances, has reduced domestic interest rates. There is also possibility, and because what is happening when I said the global growth is coming down, which means I think the other central banks will also try to support their own economy. So we will see, or I think we are in the midst of interest rate reversal cycle, which according to me is positive from the equity markets point of view. Typically, when we look at equity, try to value a company, right? So we value the future cash flows. So we use some discount rates for that. So interest rates play a very important factor. Lower the interest rate, lower the discount rate, which means higher the value which one would ascribe to the companies. So to that extent, I think interest rate reversal again, is a positive factor, I would say, from the equity point of view. Yeah. So government, yeah, sorry, what you're trying to say is that what is government done or trying to do? So clearly, so this is a important chart for one need to again know what has happened or what is changing, particularly in the last 1 year, right? So the blue line is the capex of the government towards the infrastructure or the capex number. So when the current incumbent party came, so that at that point in time, roughly 2 lakh crore used to be the annual capex number for the government. Now that number has moved from 2 lakh crore to 11 lakh crores. So it's a big jump which has happened over the years. If you think as a percentage of GDP, so it's a gray line, as a percentage of GDP, it has moved from 1.5% to 3%. So clearly the focus of the government right from, let's say, 2020-21 to 2025. So all this period, that was the period where government focused on capex. So be it railways, be it roads, be it defense or any other infrastructure, let's say urban infra, metros and all. So there are meaningful projects which government took in the last few years. But all these were, I would say, a supply side reforms apart from other reforms which will cover. But at this, when this was happening, clearly, the consumption was slowing down. What we saw in FY25, so they did a pivot in in the recent budget. So government moved from capex to consumption. So what they did in the budget was, the incentives in terms of anyone who is earning less than 12 lakh rupees, he will not have income tax. I think the number which is estimated is roughly lakh crore in terms of going into the hands of the taxpayer. So this was the, I think, I would say, pivotal point in terms of change in the government stance, which happened in the start of the FY26 budget. If you can just go back, one also thing I wanted to point out. If you look at the the orange line, so that number is a subsidy as a percentage of GDP. So if you recall, at one point in time, petrol, diesel prices were subsidized to great extent. Fertilizer was one of the biggest important element in terms of subsidy. At some point in time, that number had peaked to 3.5%. So I think all that savings in the subsidy were used by the government to do the capex. I think that is what they had done in the last few years. But now again, this year have moved to consumption. Yeah. So yeah, so many things has been done this year by the government. So I'm just trying to make a case, why we think that consumption should revive, in coming period. So first, as I said, income tax relief, it was roughly, let's say, 0.3% of GDP. Then different state governments are trying to do, to the extent possible, whatever their, whatever their budget supports. There's also some cash transfer schemes which actually happened after so many years, which is happening. Then on the monetary policy front, as you know, there's a big boost on the liquidity which has happened. Uh, then GST is the current reform. 8th pay commission, while I think it's a future thing, it will happen somewhere in 2026. There is some delay on that part, but the effective date is, I think, the 1st January 2026. So whenever that is implemented, you will also get the arrears, of the 8th pay commission. So multiple factors have been, done, and all these are additive numbers. It's not that, if somebody gets X, so doesn't will not get Y. So from the economic point of view, everything gets added, so to that extent, which means higher money in the hands of consumers. So last few years, if you look at, just to give a context, so one would say, is this a 1 year phenomenon? Obviously not. So the reforms has been going on for quite number of years, for the last, I would say, 10 years. So just to name a few. So one, if you recall, digitization in India, right? So 10 years back, digitization was almost not there. Now, India is one of the most digital country, I would say, in terms of, in the global context, be it payments, be it, KYC, whatever you call it. So the onboarding of, new clients, so everything is much faster. So that's one. Secondly, if you think from the institutional reforms point of view, right, apart from GST, there was a banking sector reform in terms of bankruptcy. On the real estate side, RERA is what which was implemented. At the same time, government realized that, India corporate has to be at par with other East Asian countries. So to that extent, the corporate tax rate was also cut down, and we are comparable to other East Asian countries. In the last few years, government has also implemented this production linked incentive scheme. So, it's a big potential. It can easily add to the extent of, around, let's say, 1% to the GDP. So multiple reforms has been done over the years. So as I look, next 3 years, 5 years, 10 years, so all these reforms will, kind of help India to achieve, the GDP growth rate number, which can be upwards of 6, 7, 8% or so.
Sure. So quite a few reforms that government has initiated since the start from
Yep.
2014, and even the recent years, the pace has in fact increased. And we might, this may not be the end. We might see a couple of more reforms on the labor side and other reforms. Coming to consumption and credit revival, what do you think would be the key enablers for consumption to revive, for credit to revive? Because these two are the pain points, because credit growth has been weak for some time now. Consumption, while urban was doing well a couple of years back, now urban has been weak, whereas rural was not doing well. Now rural has started doing well. So what collectively would lead to a revival in both credit growth as well as consumption? Because these two are interlinked as far as economy is concerned. So until unless your consumption does not pick up, your credit growth may not pick up, and vice versa. So, what factors do you see will structurally drive these two? Uh, if you can elaborate.
Sure, sure. So I think, if you look at credit growth, as you said, has been weaker, particularly the last 12 months or so. So if you look at bottom left chart, the light blue line is the overall credit growth in India, which was growing, to the extent of 18-20%. But now it has crashed to a higher single digit. I think last fortnight it was back to 10% or so. So what had happened is that, in RBI last year sometime, so, there was quite a few things which were done, either I would say punitive actions, or it was highlighted in terms of, stress, which was some stress on the unsecured front. So to that extent, a lot of curbs were there in terms of credit growth. So last year, I think that clearly impacted the credit number, and it happened in a very short period, short time period. That I think continued for quite some time. So that is the reason, when I said on the budget side, we pivoted away from capex to consumption. RBI then in the last 12 months had done quite a few things interesting, in order to boost the liquidity. So if you look at the top flow chart which we have done, is that so they have done multiple actions either in terms of buybacks, OMO repurchases, or auctions. So all put together, I think almost to the extent of 10 lakh crores has been infused. CRR cut, I think somewhere in September, I think in the 2 3 tranches, the banks will also get benefit of that. So multiple things have been done in order to boost the credit growth. While I think only it was the first fortnight what we saw when we moved from the higher single digit to a double digit. This was also the fortnight where credit growth was ahead of deposit growth. So to that extent, I think I would say some green shoots are being seen. One example which I wanted to highlight was in terms of interest rate reduction in the last 6 8 months. So if you look at typical home loan EMI, so let's say somebody takes a 1 crore home loan, so what is the reduction he could have in terms of his EMI? So on the bottom right side we have looked at, so the example is basically rate when start of the year was, let's say, 8.6%, has gone down to 7.5 or 7.6%. Almost EMI has reduced or will reduce to the extent of 8%. I think it's a meaningful reduction. So this is just an example of home loan. This can also be applicable to two-wheelers, four-wheelers, white goods. So anybody who is trying to consume or buy something through loans, so he will see anywhere between, I would say, 6 to 8% reduction in EMI. So I think that is a decent boost in terms of consumption which will happen, and hopefully we'll start seeing that in the coming period. Yeah. See, auto is a very important sector from the India point of view. What I understand is auto is to almost to the extent of 40 to 45% of our manufacturing base. So I think auto doing well is quite critical from the growth rates perspective. Here we just tried to give some context. So this is on the base of 100 of FY19. So two-wheelers and entry-level cars. Mind you, these are entry-level cars, not the total car sales. So two-wheelers and entry-level car sales in the last 6 years, 6 years have passed since FY19. So in the last 6 years, it is yet to breach the previous peak. So this kind of shows the weakness in terms of consumption. So on the two-wheeler front, see, there are other factors also, like the insurance cost moved up, and also there are some other factors which led to increase to the prices. But nevertheless, I think this is what is the weakness in the economy. So hopefully, with this GST rate cuts, with this interest rate reduction, income tax benefits, so all this put together, plus I think two-wheeler, for example, is largely driven by the rural. So I think monsoons doing well. So multiple factors should drive revival in this sector. Yeah.
Sure. So while we talked about what factors can lead to a revival in consumption credit growth, so eventually, as an investor, how one should go about it, where the markets are headed, and will this reform really lead to some animal spirits in the markets, lead to some revival in sentiments of the markets? Because the day it was announced, the very next day, we did not, in terms of market reaction, it was quite muted. So just trying to understand whether this will have a long-term implication on the markets as well. While you talked about economy, how does it pan out for the markets? If you can just let.
Sure. See, I think market reactions, one should also keep in mind, that Prime Minister had announced the same on 15th of August. So to that extent, between 15th and August until yesterday, so there is also anticipation of also which sectors we could see the benefit from various media news articles. So to that extent, those sectors had already companies are already moved up. So that's the reason I believe markets didn't react the way they should have. But mind you, it's too early. We are yet to see that in numbers. I think one should not give too much importance on on the one day reaction. I think it will take time for everyone to sink in. Once we start seeing the monthly numbers, I think then I think the people will again believe that. I mean, till then the consumption will start reviving. From the market's point of view, one factor I think which people are talking about is this FPI or FII selling. So I just wanted to give one context here is that if you look at let's say total India market cap of roughly, let's say, 450 lakh crores, right, which is currently. So FPI still continues to own 16% of it, which I think roughly 70-75 lakh crores or 75 trillion rupees. So it's a meaningful number, which is still owned by the FPI. So selling by 4-5 billion dollars in 1-2 months, so that's not much of a big deal. And for them, it is more about deciding between, let's say, India versus, if you look at last few months, it was more about money. Some money, what we understand, is flow through China or Korea or Taiwan to some extent. So for them, it's a minor adjustment or asset allocation which happens. From the global context point of view, we India with a $4 trillion economy is still a smaller economy vis-a-vis where US, China and other economies are. So a small percentage change here and there, while it could be meaningful from the monthly numbers point of view, but it is still small. I think the good part for us is that we have this large SIP flows or domestic flows. I think which are adequately countering this outflow on a monthly basis. So that is, I think, the market context which I wanted to give. Yeah. So here you can say, if you look at the shaded
Sorry, audience. There's some technical snag due to which we are not able to connect with Harshad. Please hold for a moment. We'll be right back.
Where did you lose me?
Yeah, so you were talking about the indices, sectoral indices, how the sectoral indices have performed in the past.
Sure. So what I was trying to say that in the last 3 years, if you look at across the sectors, the top yellow line, so there is a decent return on a CAGR basis, which we have made across the sectors. FY25, as you know, was a kind of a pause year. This year also, if you look at returns point of view, largely flattish at a headline level. The point is, after a decent return in terms of money which is being made in the market, so earnings catch up needs to happen. So to that extent, I would say this is the year or the last 12 months is the period where earnings catch up is happening. But we believe that second half of this year could be much different than the first half, given that whatever has been done by the government, by the RBI, and now with this GST reform. So let's hope that second half could be a much better than the first half. So I think while this is a data heavy slide, but let's look what we have tried to do is try to look at Nifty 50 earnings and what is the consensus estimate in terms of FY26 and 27 on a sectoral basis. So if you look at only sectors which are I think the globally driven or globally aligned sectors like pharma and IT and oil and gas to some extent. Just focus on the last right hand side column. So these are the two, three sectors where I think we are looking at a single digit growth. But X of that, there is a decent double digit growth which is expected in FY27. So FY25 growth, this is the Nifty 50 PAT level total number growth was 8%. 26 is similar to 25, but I think these numbers, obviously don't include this GST reform which has happened. So to that extent, I suspect and I believe that there would be some earnings upgrade which will happen on FY26 numbers. And then after that FY27, we are looking at a decent, 15% kind of earnings growth. So I think consumption, yes, there is a revival which could happen in the coming period, but X of consumption also, there are many other sectors which we believe the normalization and a decent double digit growth which could happen. Now, coming to valuations, I think this is the most important. I mean, till now we saw, what government has done. Then we also saw, FPIs. While it is important, but I think in the whole scheme of things, one should not, give too much importance to that. One should focus more on the earnings growth because eventually, when we invest money into the stocks or when you invest money into the mutual funds, it's all about in the companies which we buy. So as long as I think the earnings growth is there, one should not be too much worried. So let's cover the valuation. Obviously, earnings after earnings growth, what matters, what price you pay. So in that context, I think let's look at left hand side Nifty 50, 1 year forward P. So Nifty 50 is roughly trading at around long term average, roughly around 21 times. Mid cap, on the other hand, is trading at a premium to long term average. And I think if you look at the mid cap premium to large cap, I think that is also slightly higher. Small cap chart we don't have in front of us, but I think if I were to marry, earnings growth and the valuation, so within that, I think small cap will slightly look better vis-a-vis, mid cap. When I was talking of earnings, so on the left hand side, one important factor, is that FY20, somewhere in FY20, India Inc. ROE was in a single digit. Now that has moved to a double digit. So we have seen a decent recovery in the last few years in terms of profitability of the India Inc. The one important factor, I think, for which obviously we don't have a slide, but one important factor which everyone is waiting for, is revival of the private capex. So when I look at FY27 earnings growth, so some part of it is there is also factored that private capex should come back. So to that extent, I think the setup is quite decent. While on the valuation front, I'm not saying markets are cheap, valuations are, quite richly valued. But at the same time, we are seeing decent corporate earnings growth, which is happening. So to summarize, I think before Q&A, just to summarize, so policy shift has happened from capex to consumption. So we talked too much on it. I'll not focus on, not try to look at that. But I think the more important is, we have right demographics, we have our monetary and fiscal policy in alignment. So to that extent, this is the first large demand side reform. So I am much more hopeful that, some positive outcome should be out of this. Coming to market dynamics, again, there is a volatility. There will be volatility, and these are the equity markets. That's the way they are. I think don't be too much get bogged down by the volatility. But I think in the global context, India is insulated, relatively better insulated from the tariff shocks. I think we are not seen end of it. What we understand from the government or from what media reports is that we are still in the midst of negotiations for the tariff. So 50% is not the end of it. Let's be hopeful. Hopefully things should be better than that. Valuations, as I said, large caps look relatively better. So from the portfolio perspective, one can have higher share towards the large cap. On the earnings front, I think pre GST reform, I would have said that we have seen the end of earnings downgrade. But now I think I am tempted to say that there is a possibility that December quarter we could see earnings upgrade also. So that is a possibility. Maybe there could be a positive surprise on the FY26 earnings. So let's see how things pan out. From the funds point of view, clearly I think we would say that one should have consumption from the sectoral fund point of view. Then large cap, flexi cap, multi cap, also large and mid, one can look at. Hybrid can be clearly a core strategy now. While I think one can do SIP in others, but if somebody wants to do lump sum, I think hybrid can be the one category where one can do lump sum. And lastly, I think obviously, don't want to, so we have been saying on time and again, is that while it's a bottom investing, but from the investor point of view, one should stick to his own asset allocation and, disciplined approach, and obviously take help of the advisor. Yes.
Yeah, thanks, Harshad. Thanks for giving a very insightful understanding on the GST reforms, the context, and how it may impact the economy and the markets, and what is in it for investors from an equity standpoint, where they can look at from a medium to long-term perspective. So, participants, now we have opened the floor for questions. In case if you have any questions, you may put in the Q&A box. We will try to address most of them. So, Arshad, one of the questions on the insurance side has been, uh, if I heard the finance minister correctly, she clearly mentioned that it is only on the individual life and health insurance policies. So, any other in terms of auto insurance or group policies, do you see any impact there, or that remains as is?
No, I don't think anything has been said on auto and
Sure, sure. So in terms of implement execution of this GST reform, how in the next what 2 or 3 quarters do you see the impact or positive impact of this coming into earnings?
So yeah, I think so. What has happened, unfortunately, because it was preemptively announced. So on the 15th of August, and the implementation took some time. Effective date is 22nd September. So in anticipation of that, people have delayed their purchases. Thinking or knowing that prices will come down. So to that extent, I think we would be seeing lower numbers, in the September quarter. But obviously, we'll have to see through that, not give too much importance to the September quarter numbers. We'll have to obviously wait for the December quarter, and in the September quarter, I think the important is see results will start somewhere in 15th October and beyond, and will move through mid-November. So I think management commentary will be the guiding factor, and
Sure.
people and investors will and should not give too much importance to the actual September quarter numbers. But again, I think, while this is too much short term we are talking, please focus on the long term India story, which, we have spoke about. I think it's not about 1 or 2 quarters. It is
Right.
more about, 3 to 5 years.
Right. Sure. While there's a question uh, uh, on the earnings front, you have already mentioned, particularly on the IT sector. How do you see, what is your view on the IT sector as a segment? While it has seen quite a few correction, from a valuation standpoint, is it a good time to look at IT?
So the ground reality on the IT is, the large projects, or I would say transformational projects, are still delayed. Large US corporates are still not deciding on that. Earnings growth or top line growth for the IT companies from for the top tier, I'm saying from 15-16% has come down to, let's say, 8 to 12%. Kind of projects which are happening in the last 1.5 year are more about cost cutting kind of projects. We'll have to wait, let this tariff situation. See, the point is BFSI as a sector is doing well, which is a large part of the IT segment, but sectors like retail, health, manufacturing. So those other segments are not yet firing. So to that extent, I think IT is going through its own challenges. There are also challenges in terms of AI. The only positive, part to look at it is, valuations are near long-term averages or slight discount to long-term averages. So not much of a worry. We are also looking forward, and everybody is hoping that, there could be some rate cut cycle which could start in US. So to that extent, it could be positive. So our stance is that, and the point is, frankly, no one can call out when the things could, normalize. But our stance is that we are typically at around 90-95% of the benchmark. That's what, we are looking at. So downside risk, I don't think is too much from there. All the worst cases already played out. So we're just waiting for, things to normalize.
So, while you spoke about IT as a sector, and in the initial part of your presentation, you did talk about what sectors would be benefiting. Any indirect benefit or second order impact on other sectors like BFSI, like healthcare, do you see? And from an investment point of view, does it make sense to look at those sectors now?
Clearly, I think you nailed the two sectors, which could have indirect benefit. I think the point is, when we say all these efforts are to boost consumption, but if you say if consumption has to happen, then credit growth is also important. So clearly, I think this will boost credit growth. I think hopefully we should go back to decent double-digit growth number. On the healthcare front, I think any which ways it was growing at a decent pace. But I think with this policy rates coming down, so it should give some fillip. But I'm not saying, but unlike other sectors like, auto or, FMCG, consumer durables, and then the indirect benefit like, banking or credit growth. Yeah, I think healthcare, I think, yeah, slight benefit, I would say, but major would be on the credit growth side.
Sure. You mentioned that people can look at hybrids as a core segment. Within that, you have multi-asset allocation funds. How do you see someone allocating into a multi-asset allocation given the rally we have seen in gold? How do you see someone, how should one allocate in this fund?
I think yes, gold has played an important factor in terms of returns for multi-asset. But from the commodity point of view, multi-assets, there are two ways one can, make money on the multi-asset. One is obviously how much money you allocate to each asset class, what percentage. So for example, if equity starts looking attractive, we can add more equity to that, and vice versa. But there is also other important commodity, which of late we have added and done well is silver. So it's not only about gold, it's also about silver. And I think gold, while one can take a chance, one can, one can say that, it may not do well the way it did in the last 1.5, 2 years. But can one say that, it will again go down to the extent, it had moved up? So frankly, we don't know, because central banks still continue to buy gold.
gold has now become the second largest reserve after US dollars. It used to be US dollar, then euro, and then gold. Now gold has become number two. So I would not tell I'll still be hopeful that prices should sustain, and we will continue to hold for now. Yeah.
Sure. So I think, Harshad, since it's almost been an hour since we started this webinar, participants, in case if you have any further questions, you may get in touch with our relationship manager or your distributor, and we'll try to answer those questions. Thank you very much once again for joining into this webinar. We look forward to your participation. Harshad, in case if you have any closing remarks on GST, if you would like to.
No, I think frankly I'm quite excited to see, how it pans out. So yeah, let's see. Second half should be much better than first half from the earnings point of view.
Sure. Thank you. Thank you, Arshad. Thanks, participants. We'll end the webinar now. Thanks. Have a nice evening.
Thank you.